Well, joining us now is Torsten Slok, Chief Economist at Apollo Global Management. Torsten, it's great to have you here on a Jobs Friday where we got a very hot labor report. We got strong numbers, particularly in the inflation piece of the University of Michigan's Consumer Sentiment Report as well. We know Goolsbee tends to lean a little more dovish, and certainly got the Waller comments earlier this week that were a little bit more dovish. But then we've also gotten Bowman, who I know leans a little more hawkish, but as well as Schmidt, basically saying that, we're at neutral and near neutral, we might be done cutting. Ben Emmons talked about this today as a lame duck position for the Fed. How do you see it?
Well, you're right, Morgan. And I think the two data points we got today, namely a strong employment report and inflation expectations jumping up from 3% to 3.3%, this was not a good day for the Fed, because both these numbers are saying that the risks are indeed rising now, that the Fed may have to hike again. Because the backdrop with a dual mandate for the Fed is, of course, that we should have full employment and we should have inflation at 2%. And on both fronts, employment was stronger than expected. It was stronger than full employment in terms of the headline number that it came in and the unemployment rate coming down. And on inflation moving higher on the expectation side is also pointing towards that we're starting to drift away from the dual mandate with the risk again that rate hikes might be coming.
When you look at the jobs report today, how much of this is seasonality and just noise that we tend to see at the beginning of the year? At what point does this become a trend?
Well, this is also an important debate, Morgan, because normally the discussion in the dual mandate has been that it's a seasonality is all about inflation. There's a very significant debate about residual seasonality in inflation, because remember, of course, as we all know, the pandemic started in March of 2020. That means in Q1 of 2020, the data got really heavily distorted. And it is still the case, and I know it may sound a little bit funny, but it's still the case here 5 years later that the seasonal adjustment method can remember that there was such a big distortion in the data in the first quarter of 2020. And that distortion last year pushed up inflation in the first quarter. And the worry today is that we may also have some residual seasonality pushing inflation up. So that's why if we're now also having a debate about the labor market, maybe also having some seasonal issues that can create better data, it does begin to look more like, well, maybe we should just take the data at face value, that maybe the economy is just strong and doing better.
Torsten, with the benefit of hindsight now, how expensive is that 50 basis point cut for the Fed?
Well, this is really important, John, because if you think about it, it is really unusual. The Fed since September the 18th has been, of course, cutting interest rates 100 basis points. But in the meantime, we now have that 10-year rates are up more than 100 basis points. It is highly unusual that when the Fed cuts rates, that loan rates begin to go up. And that's, of course, why, as we enter 2025, the discussion is around exactly as you just also debated on the previous segment, why are rates going up? And what's particularly worrying about this is that the 60-40 portfolio has taken a really big hit over the last few weeks, including today, when, of course, rates are going up and stocks are going down. And this brings back memories and worries about what happened in 2022, where the 60-40 portfolio really underperformed in an environment just like we've seen today, where the Fed is at risk of beginning to hike rates again, and at the same time, stocks are going down.
So after these cuts, the Fed's not going to want to turn around and hike again. What would force their hand, and what impact do you see on equities?
Well, I do think that next week we get the CPI print. That turns out to be very important, because now we know that the labor market is stronger, and we actually also know from inflation expectations that that's also stronger. So now when we get CPI next week, we should be watching very carefully. Are there signs that CPI is still sticky, that is not coming down to the Fed's 2% inflation target? And the fear that we have is indeed that there might be some upside risk. And this is even before we have started talking about the implications of tariffs, implications of restrictions on immigration, even implications also of lowering corporate taxes to 15%, as Trump has been talking about. So the fact that inflation is still sticky at a level higher than the Fed's 2% target, we're currently roughly at around 3%, and now potentially some policies in the pipeline and a strong economy in the pipeline, that does increase the risk that we could begin to see some upward drift in inflation as we go through the coming months.